a few more people, and we have started recording this. Thank you, Eileen, uh, my executive assistant at the control panel. I'm thrilled that we're going to continue our wealth building mastermind today. We have a special guest joining us, Paul Hakim. And I know Paul, we met actually as part of our expansion of our Kingston Market Center. He owns the building where we are located in. But I found out that there's so much more to Paul. And I have learned so much through my association with him. And I thank Nate Caney, who's also on the call with us today, for introducing us to Paul. And Paul started out with humble beginnings, also as a residential real estate agent, and he has built an amazing business. And one of what we have talked about over the past week, as we've talked about the investment opportunities in title and insurance, we've talked about really starting to vertically integrate our businesses in real estate, and how we can help to sort of soothe the downward pressure that we're feeling on commissions by creating additional streams of income out of each of the deals that we're doing. And so I think it's really timely today for Paul to come in and talk to us really about creating wealth through diversifying your real estate ecosystem. So Paul, welcome.
Great, thank you. Thank you for the intro. My name's Paul Hakim. I'm based here in Kingston, New York. My primary practice is up and down the whole East Coast. We've been concentrating on Greenville, South Carolina, and Charlotte primarily over the last couple of years, and have had great success down there. But we're also very active up here buying and selling. I started as a residential salesperson right out of college in 1986. As I was telling Rosemary earlier, I was president of the Kingston Board of Realtors when it was 92, 93, when we were having debates on whether or not to go digital and leave the printed books. And we were kind of chuckling about how much the information world has changed. But that said, after my residential years, I started doing commercial real estate, buying and selling, and doing quite a bit of listing, and we were also developing and building. That broadened my expertise a little bit, and then soon after I was introduced to the CCIM designation, which is a commercial real estate designation from NAR. And it's pretty much a graduate degree in commercial real estate financing and analysis. That is kind of the math all behind it, where we can calculate after-tax returns and really model the cash flow and forecast cash flow for the commercial real estate, which really drives the value of the commercial real estate. After I was involved in that for about 10 years, I was invited to another group called the Society of Exchange Counselors, which is a national group of commercial real estate brokers and investors. And we buy, sell, and trade real estate within the group and co-invest. The difference between the two, CCIM is really the math and the structure of the deal, and really the analysis of the deal, and SEC really is the art of the deal, where we apply the knowledge and counsel our clients to a favorable outcome in their transaction. I am a licensed real estate broker, but I don't list and sell very much. I do more consulting and more on the tax planning, financing, and capital formation side of deals, which we'll get into that a little bit later. Going backwards to the SEC is an invitation-only group where we invite known entities after we get to know you You'll get invited to a meeting and you can come and transact and co-invest with a lot of our group. After you've come to a lot of meetings and are a known entity, or eventually asked to apply for candidacy. And I'm happy to report Nate Caney, who's on the call, is one of our newest candidates for the society. So he's well on his way to be becoming a member. So that said, we really pride ourselves and really call ourselves counselors as opposed to brokers. Counseling is a little bit different than taking a normal listing, because we dig into the objectives of the investor or the seller to see what they're doing. Are they balancing their portfolio? Are they selling or trying to break up a partnership? Or does one of the partners have a financial need? There's always an underlying partner or ownership issue we find in commercial real estate. A piece of commercial real estate always has value. The value fluctuates based on the occupancy, which we can forecast. We can forecast what the capital requirements are going to be to meet those income requirements. So today we're going to talk a little bit about how you can get in the game, identify some revenue opportunities, and I think more importantly, convert some of those revenue and commission opportunities into an investment in the deal and turn that into recurring revenue. As you know, commissions, times are good right now. Everybody's busy out there, market's very active, but those commissions are fleeting. Hope everybody's got a good savings program. Unfortunately in our industry, we're not known for having any type of pensions associated with our employment or independent contractor relationship. So everybody's utilizing IRAs or 401ks. I have all of my retirement funds right now are 100% in real estate. I have no money in the stock market in any of my retirement accounts. We'll talk a little bit later about self-directed IRAs and how you can get in the game and see some tax-free growth in your industry. So going back up to the top, we'll talk a little bit, and sorry if I'm rambling, stop me if you have any questions. I want to try to cover as much as I can, and then we'll jump into some questions and answers. So again, we've got different types of income. You get that commission, you earn that commission once, you've got to go out, hit the treadmill again, and create another commission. Same thing with property management. You're managing a property, you've got to work for that check every month, and those commissions are fleeting, right? So they're not consistent. We don't know when they're going to come. You've got different types of then recurring income. You've got people with the one-time types of income. Those are the people that are doing the fix and flips. They're buying a house, fixing it up, making $20,000, $30,000, $50,000 on the flip. They've got to go out there and bust their tail again to do another one, right? So it's not a recurring revenue stream. The people who are seeing the recurring revenue stream, you see people out there who are buying single fams and converting them into Airbnbs, right? But that's a job. You're turning that building over. You've got a real management intensive business there. Same thing with a 1 to 4 family. I see people all the time. Hey, I bought an investment property. I bought a 4 family. It's like, okay, great. You realize what you bought. You bought yourself a commitment and you're going to start getting phone calls at night if you're not structured properly. So, a lot of people make a lot of money doing that, but, don't be fooled. It is quite a bit of work. We've got people also who are buying single family homes and doing long-term rentals, hoping for the appreciation. That's a long game. Then we've got commercial real estate. Your mixed use buildings, industrial, larger apartment complexes. That's where you can get yourself some good recurring revenue. And we're going to talk a little bit about how to identify those and, how we can put syndications together to get you into those. We've got a really good friend. He is a frequent guest and has been coming to our SEC meetings for a bunch of years. His name is Corey Harkleroad. He's in Keller Williams, Wichita office. 2019, I think he was number 20 nationally for Keller Williams, and last year he was number 5. I think his volume number was around $90 million. He did not sell one piece of real estate. He bought the whole $90 million of a real estate portfolio, and he is poised to do $150 million worth of acquisitions this year. Over the last 3 years, he has purchased almost 60 properties, and I think they've got about 300 million under management right now. He started in the business as a residential broker about 8 years ago. Took him 4 years. He converted to commercial, and then he learned how to syndicate and identify deals and pull deals together. I know a lot of you work with teams and you've got people out there that are canvassing. So you've already got the workforce. You've got them out there looking, for deals. If anybody's interested, Nate and I would be glad to sit down with you, talk about focusing that group and identifying opportunities that you can manage and are comfortable putting a group together and form an ownership team, right? And then you can start syndicating these deals. It's not as daunting as you think. We always take a team approach on all of the deals that we're doing. In our Society of Exchange Counselors, there's 87 members, and I think there's about 200 invited and regular guests. Through that group, nationally, I see about 90% of my real estate brokerage and consulting income is processed through that group. The rest of my income is all passive. I own pieces of a lot of deals and a lot of pieces of real estate. A lot of those pieces of real estate I consulted on. I might have put the operating agreement together, put the financing together, raised a few $1,000,000 from investors to do that. And I could end up owning anywhere from 4 to 8% of the piece of real estate for sweat equity. All right. So instead of taking a fee, all right, which is expensive for somebody buying a piece of real estate to go pay a $50,000 or $70,000 fee or points on a capital raise, that's expensive for the developer or the syndicator to do upfront. So it's a lot more cost effective for them to give me a piece of the deal, and I'll get paid out over time, usually once it starts performing. So instead of taking that commission, we took a piece of equity in the deal. As a result of that, I've got a piece of a 240 unit apartment complex in Lakeland, Florida. That is under construction right now. I did the capital raise and the formation on that. Once that apartment complex is constructed and stabilized, it's about a 3-year process to go through the capital raise. We got HUD financing. I'm going to start seeing checks about $35,000, $37,000 a year at the current rents. All right. So on that, we typically see close to $100,000 fee because we get paid 1% for any capital that we raise. So that would have been about a $50,000 fee for raising the capital. And then there probably would have been about another $50,000 in other fees for structuring the deal, operating agreement, and everything. So instead of taking that commission, I'm going to wait 3 years, but that's nice to have that passive cash flow and that income. This apartment complex is highly leveraged. It'll take years we got 40-year fixed financing through HUD on this workforce development housing project at 2.7%. So we've got good leverage. It's probably going to be a long-term hold. But if we were to sell the property and there was $1 million worth of upside in the sale of the complex, I'd see 5% of that upside. So, that's pretty cool. It's not a gamble. It's a calculated investment on my part. But I've got pieces of probably 25 different projects ranging in from 1 to 8% ownership in different size deals. That one's one of the more fruitful. But after a certain point, there's my retirement plan, right? I spoke a little bit earlier about making investments. I'm a real estate guy. So we've been investing, buying, selling, trading real estate for 30 years. I'm not a stock guy. I really don't follow the stock market. I read real estate periodicals. I follow real estate news in the markets where I invest, and that's where I spend my time. My brother's a stockbroker. I share office space with him, and it bugs the hell out of him. I don't have an account with him, but I transferred all of my IRA money into a self-directed IRA. There's a website that you can go to called rocketdollar.com. It's a startup. They've been in business about 2 years, and they're an IRA custodian, but they're all online. And what they've done is created a model where you can do a rollover. You open an account with them. Say you got 100,000 in your 401k or your IRA. You can take, say, $20,000 and do a rollover into your Rocket Dollar account. And when you set up your Rocket Dollar IRA account, they simultaneously start an LLC that your IRA owns and controls. And then you get the checkbook for that LLC. So it's called a checkbook IRA. So you can roll over, whatever you want into that LLC and go around and go invest into different real estate deals. When you see real estate transactions happening, a lot of times that owner or buyer is raising capital. He's pulling his friends together and saying, hey, let's all put 50,000 into this. We do it all the time. The definition there is, yes, the name of the company is rocketdollar.com. I saw it just pop up there on the question. But the syndication process is pretty simple. We pull capital together between friends all of the time. There is 30 Act SEC requirements when you're raising capital to people or from people that you don't know. But at any time, you can pull 2 or 3 people together and say, hey, let's go buy that mixed use building on the corner. Rosemary and I were speaking earlier, here in Ulster County, the bread and butter commercial deals are probably $350,000 to $1 million. Also from a sophistication perspective, you all can probably very easily handle the transaction with a little bit of help on getting it priced right and the positioning. So, don't be afraid to, reach out to Nate or I and bring us on into the team. Nate and I have discussed, working on a sliding scale basis, just like a referral fee, participating and helping you through that. If you identify an opportunity, you see somebody selling a 200 unit apartment complex or even a $15-20 million commercial building, we have the expertise to be able to analyze that and also help the buyer. And I think that's most importantly, help the buyer over the finish line. We've got a lot of, dedicated commercial people here, whether it's SVN or, Cushman Wakefield or CBRE. I get calls from those guys consistently on, I've got the buyer, buyer and seller are going into contract, they all need help, right? So I'll come in, I interface between the architect, I'll help put a RFP package to the banks. We actually go out now and we assemble a request for proposal, an RFP from the banks. We don't go to the banks anymore and say, hey, we want to, can we borrow 900,000? We go in and say, we're borrowing 920,000. This is how we're structuring. Here's the rate we're looking for. And here's a complete analysis of the building for your underwriter and a complete submission from the owners. And that is greatly overlooked in the commercial real estate industry. There's so many deals that go into contract and never close because they were never presented or analyzed properly up front, right? So the bank gives them a big reality check, right? So it's not like a house where somebody's making an emotional decision, and they're buying, $1 million property, and, with commercial, you're putting 30% down. That affects your return on that 30% down if you've got to put more capital in. Your cash on cash returns are going to diminish greatly. So, we don't analyze the borrower on commercial, we analyze the building, right? So if I put the metrics together and that building qualifies for the loan, I can get that funded. There's a lender out there, you obviously got to have a good, clean credit score and have some track record. But a lot of times I was involved in a $15 million acquisition where we actually gave a gentleman 10% of the deal for his signature. We needed a stronger signature on the debt because it was a turnaround. The cash flow wasn't there. So the bank said, bring us a stronger guarantor. We did that. We gave him a piece of the deal. The broker who brought that deal in left his commission in the deal, and he got 7% of the deal on that. And that's pretty substantial, right? So any questions so far? I know I've been all over the place, but anything I can answer?
I think you have lots of good information. I hope that this is really opening people's minds to thinking about, how you can get into deals, and how, deals get done. I think, looking at your IRAs and doing something self-directed, that's sort of, I've heard a bit about it before. I have not done it, to be honest with you. And this whole idea of taking a small piece of bigger investments. For those of you who know my story and my background, we did a lot of development in New York, where we were the developer. We paid a lot for the land. We developed the land, and we've moved all of our stuff. And in doing so, because we're doing it out west now, we're not there. So we've taken smaller pieces also of bigger syndicated investment deals, and development. And I'm totally with you on that, Paul.
Right. And, we don't invest blindly. So, that's one motto is you never gamble in real estate. We make objective decisions here and we make educated decisions. So we analyze the hell out of everything. We have some very complex spreadsheets. There's a lot of fundamentals that you can apply. Obviously, we need to know the market and where the growth is. Like I said, we were poised, and for the last 3 years, we've been canvassing heavily down in the Charlotte and Greenville, South Carolina markets, and primarily in the industrial space. And then fast forward into COVID, we've had lease rates almost double. We did actually just completed a very creative transaction. And I think that, that's another thing we can touch on is, the creative aspects of a transaction. But we actually got control of, because you don't need to own a piece of real estate to extract income from it. You just need to control the piece of real estate. We shook hands on March 8th last year with a seller, on a price. It was a building that he bought and was flipping to us. And then fast forward the next day, I get a call from my wife. I was with my son. She said, "You got to get home. National Guards in Westchester, they're shutting the world down because of COVID." So we were down south. They hadn't even heard of COVID yet. But while we were driving home, my son's typing up the LOI on everything we had discussed the day before. And I was like, boy, COVID, we were at the point where we were going to ask for a 90-day due diligence period. And I was like, is that going to be enough? We need a clause in here if the world is shutting down that, if it's COVID related, that we need more time to perform. So I said, before we submit this, let's just call the seller. So he was like, hey, I was just going to call you guys because I thought this through, and I'm flipping this building to you. So I won't have owned it for a full year, which is going to turn this into earned income for me as opposed to a long-term capital gain. So his taxation would have been almost double on his gain. So he said, can we go into contract and wait? And I said, I'd rather have control of it. So I said, why don't you master lease the building to me? All right. And give me control of it for 2 years. And then I will buy it between year 1 and year 2. So between months 12 and 24, I'll buy this building. At that point, the building was vacant, 108,000 square feet, $1,750,000 purchase price. So we structured it that we put $100,000 down. We owed him $1,650,000 at close. So we were leasing it from him with an option to purchase, right? So we structured it at a 4% interest only was our payment, right? So he still has the deed. It's kind of like owner financing, but it's an option. So we put $100,000 down. We're paying about $7,500 a month. Again, the building was vacant. We put a $350,000 roof on the building. And then we leased the whole building up. COVID was a blessing because it pushed a lot of distribution companies sideways into extra space. So we were able to lease the whole building. Current net operating income before debt service, it's a net lease. The tenants are paying the taxes. We're collecting $320,000 in net income off of that building. And we still have a $7,500 a month mortgage payment, right? So we're still just paying interest only on that. We have received some unsolicited offers on the property at $3.8 million. So, that was kind of a diamond in the rough. But, we turn a lot of stones over. In that market, we probably had sent out over 30 offers and solicitations, and this one bit. So we were in the right place at the right time. So, I probably do at least 4 or 5 offers on commercial real estate in different parts of the country per month. We analyze, we canvas. My son, Nicholas, has some interns working for him. He's also got some of these internet guys that do solicitation stuff for him. But my son, Nicholas, and his partner, they probably send out 5 offers a week on mobile home parks. They are very active in the mobile home park space. They've got mobile home parks in 5 states in the South now. And that's all they do all day long is call mobile home park owners. And, look for those diamonds in the rough. That industry is kind of like the bowling alley industry. Most of the owners there were, in their 70s and owned the place for 50 years. That's your typical mobile home park type property, right? So they look for, that 100-unit mobile home park where, the owners, it might be a little bit tired. The owners are only getting $300 a pad, but the market's $500 because it needs a little bit of lipstick, right? So that's what they're going in, putting the CapEx into the properties, turning them around. Um, I believe with the acquisition that they're closing in a week or two, they'll be at 1,400 units or pads, and they'll be probably doubling that by the end of the year. But they're aggressive. They offer what they think it's worth. So, a lot of times we'll see a piece of commercial real estate that's listed for $4 million, right? And it's like, call, hey, how'd you get to that number? Give me the income, give me the expenses. My offer might be 3.2 million, but the offer goes out, right? Because I took the time to analyze it to back into that reality check for the seller or the broker who might not have listed it properly. How many times have you seen a house out there or a residential property that was like, why is that $1 million? Right? That's an $800,000 house because they lied to the seller and said, I'm going to get you $1 million, give me the listing, right? So, in that situation, it's better to be the second or third broker with that seller, right? Because by that time they've seen enough $800,000 offers that they're finally going to take one, right? So we're never afraid to analyze a property, and if we're going to analyze it, it's pretty easy to put an LOI together and say, I'll accept this offer at $3.2 million. No, I haven't seen the property, but I'll be there in 2 days, right? I'll fly down, accept this offer, and I will be at the property in 2 days, and we close. That said, through COVID, I put 31,000 miles on my car, right? Because I wasn't flying. We were analyzing a deal in Bloomington, Illinois, south of Chicago, another one in Indianapolis. I was in Knoxville. I was in Charlotte, Nashville. I was all over the place through COVID, but I was driving, right? Because we were still canvassing and placing those offers out. And when we got a bite, all right, I wasn't there in 2 days, but, I was there pretty quickly. And, once your boots on the ground, you learn a lot very quickly. And as far as boots on the ground, that's another big benefit of our group, which is like a fraternal group, right? So like I said, Nate's a candidate. Nate's being hazed right now, all right? So I keep telling Nate, you come to the meetings, watch what you say, who you say it to, you just be careful because this is the fraternity, right? So we're looking for like-minded people that we can trust and do business with. One of the premises in the society is, God, would I let Nate stay at my house if I wasn't home? All right, do I like him that much? And how many people do you do business with, and professionals that you do business with, would you do that with? Say, hey, come stay at my house. You're passing through town.
Okay, baby, have fun. What are you doing tomorrow?
I'm busy tomorrow. No, but like that said, I've got like when I went out west to Illinois and through Indy, we've got a member friend, Mike Lane, who's in Columbus, Ohio, and I called him. I was like, hey, Mike, I'm like 2 hours out. Can I come crash with you? And he's like, hey, I'm not home. I'm at my parents', but the garage code, right? That's pretty cool. That's a good friend. That's a co-investor. And, we like doing business with people that we like. So that way it's not work. And, you build a level of trust within these investment groups. There's always money being raised. There's always deals being offered for opportunities to put a syndication together. So, again, if any of you ever want to talk about dipping your toe into the water and investing alongside of us, and I think that's the key is, we don't really look for investors. We look for partners, and, would love to get to know all of you and be co-investors with all of you.
Paul, for the purpose of the call here and wealth building, could you talk a little bit about how money finds deals, or deals find money? So, it's like you're always telling me, just find the deal. It doesn't matter if you don't have the money. If you find the deal, the money will come. And we can elaborate on that a little bit more. So with everybody in the call, everybody will be in a different end of the spectrum in terms of comfort and risk tolerance. So there's going to be some people who potentially could be like a Corey Harkle Road and turn their residential listing and sales career into syndication, or there could also be people who just keep where they are with their bread and butter, selling houses and making that money, but keeping that money and then investing it into deals that you do or that Corey does.
Right, sure, and that's great. And that's so it's a segue. So and it's more from your investment tolerance than making it and changing your career, right? So you're good at what you do. You're all high performing, mostly residential brokers. And listen, that's the bread and butter. That's paying the bills. And the majority of the guys in our group, they're commercial brokers and they're still brokering, right? Because that's nice cash flow, right? But at the same time, they're investing wisely in things that they know and understand. So they're building a capital base, right? So as opposed to putting your money in the stock market and not having control of it, you've got more opportunity to really see a good return that's tangible and play the appreciation game. So when you identify and you see a property out there and you see a lot of activity around it, and you go into these markets and you see, boy, that's a really nice building, I'd like to own that. How do you do that? And I don't care whether it's an office building, mixed use, or retail. Reach out. We can do an analysis of it pretty quickly. So what do you say, Nate? Like a first round analysis on some base information, we could probably turn around in a couple of hours and go through different levels of analysis. The first one would be, you see cap rate term thrown around all the time. So, what that means, and that's a measurement of the investment vehicle, right? So that's assuming you pay all cash. If you see a property listed at $1 million and the real net operating income, so no debt service, assuming you pay all cash, but you pay the taxes, all the operating expenses, and say that property nets you $80,000. That's an 8 cap. That's an 8% return on your $1 million cash investment. All right. But nobody pays cash for real estate, do they? Well, maybe now in residential if you want to close. But now we put in leverage. All right. So now I put 30% down. I get a 70% mortgage at 4%. I can calculate now what the efficiency of my $300,000 in that $1 million deal is. Right. So now that'll show me what my cash on cash return is. Right. So that's measuring the efficiency of my capital that's in the deal. Right. And, right now, if you've got an 8% performing building and you can borrow at 4%, you've got positive leverage. So you can bump your cash on cash return with leverage from that 8% that the building performs to maybe 12 or 14% return. The next level of analysis is internal rate of return. Now, to calculate that, we have to go back to cash. You've got to actually sell or forecast what the piece of property is going to sell for. For example, that building down in Greenville, we put $1 million. We put $400,000 down. Technically we have $1.6 million in owner financing. If we were to sell that for $3.8 million, so now I've got incremental. I've got good cash on cash coming in for the 2-year hold. But if we were to sell that for $3.8 million at the end of the term with that big upside, my overall return now, including the appreciation on that, could be close to 27 or 28% based on the amount of cash that we have in the deal, right? So, first is the scratch and sniff test, is the cap rate. Okay, then we look to see what financing would be available. Then we'll look to see, I like problem properties, all right? Because it's typically not a problem with the real estate. It's usually a problem with the ownership. A lot of times you'll see a nice building on a nice commercial block that's empty and it's ugly, right? The owner doesn't have the money to invest in it to turn it around. He, might not be realistic about what the market is and asking too much rent, right? So there's a lot of factors in there. It could be an estate, right? So, when you see those properties and you're out there and knocking on those doors, identify them and, reach out, and be happy to first analyze it as an investment for ourselves. And then secondly, we can look and see, what you should be listing it for, or advising that owner what they should be selling it for. And again, we can work on a nice, to call it, consulting, or like a referral fee type sliding scale. And, for the easier buildings, sure, it could be, we could participate in a listing with you for anywhere from 20% to, maybe 50% if it's a 300 unit apartment complex that requires huge analysis. Now, I think another thing to, touch on is all these economic development incentives. That's something that you don't really see in residential real estate, but greatly affects the returns. The majority of Kingston, uptown and downtown on the waterfront, is what's called an opportunity zone. Okay, so there's tax credits and tax incentives for people to come and invest in those areas. There's things like accelerated depreciation from the 2017 Tax Act. There's other strategies that we can employ to bring in more money into the deal. Historic tax credits, brownfield tax credits, and that all enhances our return because it's potentially reducing our capital costs. So look for those diamonds in the rough, and look forward to some questions here.
Wow, is this who is liking this information? Who is finding this valuable? Great, good, yeah. And so Lori had asked the question. So for someone who is brand new to commercial real estate, realistically, how much money to get started, and what is the best first step? And Nate gave you an answer that said the best first step is to accumulate cash for investment. At 50,000 and up, you will begin to get access to syndications. I would just add to that also that I don't even think it has to be that much money if you do it with friends. If there's, and I think what Paul said was really important before. If you find a deal, the money will come. If you have an investment that makes sense, and we just saw that in the last week. I mean, we raised $500,000 from our investment partners, agents, for businesses that are going to make sense. And you see that. And so you can definitely raise the money, especially because we all have a sphere of influence in real estate, right? So we have people around us who understand and know real estate. And I think that you just have to find a deal and then find the people who understand that deal, and they'll be willing to invest with you.
So for example, my son Nicholas is 28 years old. He's 5 years out of college. He and his partner have taken down almost $30 million in mobile home parks, and they've raised over $11 million in the last 18 months. They're putting, they're charging fees, but they're putting their fees back into the deal. So they're participating in the deal, but they're young and aggressive, and they know how to model and show what the upside's going to be. All right. So Nate's really good at that too, modeling and working on the spreadsheets to go show, because what we'll do is And what Nicholas is doing, he's showing what the IRR is, because he's saying, we're going to put $3 million down. We're going to get a $7 million mortgage, and then we're going to also spend $1 million on capital improvements. And over a 24-month period, or we're going to raise all the rents from 350 to 500. So that income stream, the growth in that income stream is what's analyzed, and we can forecast what the sale price of the property is. For example, mobile home parks right now trade at about a 7% cap rate. Okay. So that's really all we need to know, right? Because now I know that it's kicking off $100,000 NOI divided by 0.07. Okay, that's what the value is, right? Now we get the income back up to, you get that income net up to 200,000 or 150,000. Again, it's a math problem. I know investors pay 6.5%, 7%, for mobile home parks. So again, we back into, and the property is worth what the income stream is, because I'm not buying sticks and bricks. I'm buying income, right? I'm buying a stream of income. I'm buying a mutual fund, right? The other part of that equation is that guy selling that building for $1 million, all right, and its NOI is 70,000 or 80,000, all right. You got to look at what the deferred maintenance is, right? So that's a stabilized stream of income that I'm buying. So if it needs a $300,000 roof next year, I'm really paying $1.3 million for that $70,000 or $80,000 net income, right? So you want to fully understand what the capital expenditures are going to be, and forecast it all. It's a business plan.
I think
For those of you who don't know, mobile home parks are cash cows. And I will tell you that if you have a mobile home park that works, I'm an investor for that. Right, Nate?
That's right.
But I might have to keep Nate out, so.
Yeah.
I wanted to also add too, for, just to go on a little bit more detail for Lori's question about how much do you need and what do you got to do to get started. If you want to get into a typical syndication that Paul and I see from the Society of Exchange Counselors, $50,000 is typically the minimum investment. Some of the deals, the minimum is $250,000. But as an individual, if you don't have enough money to meet the minimum investment requirement, but you like the deal, you can also create your own LLC with your peers. So if you have 5 people with $10,000 each, you can create an LLC that includes those 5 individuals that then can invest that $50,000 as an entity into the syndication. So, when you start to think about, how do I accumulate enough capital to get into something, that's a good way to do it. And if you don't have that amount of money on your own, there are other ways to accumulate that by bringing people together. And then if somebody wants to, kind of run their own deal, but not invest in somebody else's, having any amount of capital in an account ready to go, we as brokers get a firsthand peek into any deal in our markets. And, if I keep enough capital in reserve that I see a really good deal and I know that there's a lot of value in it, as long as I have enough money to make that earnest money deposit on it and get control of the deal and get it in contract, then I can, come to everybody in this group and I can go to everybody in the SEC and I can start raising the money to close the deal. So the way I look at it is keep as much capital on hand as possible. Continue accumulating it. So you're either using it to lock up a deal and then trusting that because your market knowledge is so good that that money will come, or just keep accumulating it and invest it with somebody like Paul in one of his deals. And then, you stick to your bread and butter. If you're selling single family homes for $1 million plus left and right, that's a lot of money, and if you're making $500,000 a year and you're able to provide for your family on 100,000 of that, and then the other 400,000 just continually gets reinvested every year, that's a pretty lush retirement. But if you spend that $400,000 a year on, new clothes and cars, those are all depreciating assets that go nowhere. So, I think we all have a great opportunity in this market and this company and this business to take that capital, turn it over into something that just makes our life get better as the years go on.
And to Nate's point, you guys are the first line of defense. You guys are on the street, you're out there canvassing, change your focus a little bit. Spend 5% of your time, pick an asset class, pick, mixed use, like the Uptown Kingston type property, target a different type of seller, and you'll learn a lot just by talking to the sellers and soliciting that sale. Another great place where you can go out and see a whole pile of deals, because that's the best way to do it is, dive in and, I did that to Nate when Nate was starting out. We just kept throwing deals at him. Like, hey, Nate, what do you think of this? Hey, put this in the spreadsheet, plug all this kind of stuff. And it takes time, but, you develop a skill set. There's a couple websites, well, there's probably a dozen of them, but go to crowdstreet.com or realtymogul.com. And those are syndications, so those are, larger deals that you can go into with $5,000 or $1,000. When they're raising, $5-10 million, but they'll do the accounting and present to smaller investors bite-sized pieces. But I'm not saying or recommending any deals or websites, but click through all the deals. You'll see how they're structuring them. They're all in the same format. They're all going to show you, current income, projected income, capital expenditures. We use, and then the industry uses what's called an APOD, annual property operating data sheet. All right, income, expenses, net income, and financing, right? And then you can boil right down into what investor return is. So go click through a dozen of those on those websites. If you got any questions, we're around. Just don't hesitate to reach out. And we talk deals every day, all day, right? So that's what we do. So always glad to look at a deal and go through the process. There's a lot of revenue opportunities out there that are overlooked by residential people. And again, you guys are the front line of defense here, or a line of attack.
Yeah, and Paul and Nate are going to be talking more about this. They had done a class for us a couple of months ago, and it's identifying commercial revenue opportunities. So getting even more in depth into this topic. The next one they are going to do is going to be on July 28th at 1 p.m. That will also be a Zoom. So, mark your calendar and look for the link on the training calendar that's going to be out for July. So that's July 28th at 1 p.m. Paul and Nate will be doing identifying commercial revenue opportunities. Paul, I have a question. Right now, I know it varies by market, but what would you say is the top asset class that you're looking at that you think presents the most opportunity in the next 5 to 10 years?
Well, so for locally, for the Hudson Valley, I think it's last mile distribution. All right, so that's what I am looking for, is 80 to 100,000 square foot buildings. We've been offering on vacant big box stores, or we offered on a large vacant grocery store up in Hudson. And I think all that last mile distribution. And in other markets, we're looking at the same. And some of those markets, I'm even more concentrated on food distribution, which will have a refrigerated component in it. And that's driven through COVID, seeing all of these companies like Instacart out there, who you can do your online shopping, or here in Hudson Valley, you go into Hannaford and you're shopping, and then you see that guy or gal going down the aisle with the cart and they're filling like 5 orders and they got the scanner and they're filling 5 orders for pickup or for delivery, right? Look at the inefficiency there. You know, that's where you make money, when you can solve a problem with efficiency. They're delivering product to the store, taking it off the truck, taking it from the back, stocking shelves so that somebody can pick it for it to go back out the back door, right? For either a delivery or for a curbside pickup. That should all be done from a warehouse, right? So that can be done from a central warehouse as opposed to moving that product 6 times before it goes out the door, right? Keep it at the warehouse and do the picking from there. So there's going to be a lot of consolidation in that. We're also in a couple of markets looking at creating ghost kitchens. We're talking to an operator now in the Buffalo market. And this building is going to be about 30,000 square feet with a large freezer component. And they're looking at and soliciting 8 fast food franchises that are in the bigger cities, all this Uber Eats and all these fast food delivery services, right? Same thing. You know, why do you need another kid at the McDonald's counter, right? And run it through there when McDonald's can be distributing from one central location for all of its home orders. You know, again, that's like an urban problem, not as much here in the Hudson Valley, but you know, a lot of these markets, you know, that's all about last mile distribution, right? So it affects everybody, not just grocery. It's even, you know, in the fast food industry.
Interesting stuff. Anyone else with any questions for Paul or Nate as we wrap up here? Okay, well, if you'd like to hear more about this, again, mark your calendars, July 28th, 1 p.m. Paul and Nate will be giving their class on more commercial revenue opportunities. I thank you, Paul and Nate, both for coming on. And I'm sure that you have helped us create opportunities in the future today. So thanks so much, you guys.
Great. Okay. Hope you enjoyed it. We'll see you in a couple of weeks on the next class.